Edward Brown, host of the Best of Investing, here to remind you to tune in this week on Saturday at 8 p.m. We're going to be talking about real estate and the economy and interest rates. You're not going to want to miss this show. That's the Best of Investing on Saturday at 8 p.m. Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate given away during this show. That certificate's not sponsored by the radio station, but by Tanbella Tanning Salon with 2 locations in San Francisco and 1 in Marin. Today's trivia theme is movie trivia. We'll have some fun with that. Now, today we do have a special guest, Andrew Kim. Today's episode is how to be a safe but lazy investor. I love that. All right, Andrew Kim is the founder and CEO of Share, an end-to-end investment platform specializing in U.S. single-family rentals. With a background in building technology companies and a personal portfolio of 20 single-family rental properties, Andrew created Share with a mission to simplify the real estate investment process and foster financial security for individuals. By merging his expertise in both technology and real estate, he aims to empower wealth growth in this lucrative asset class. Andrew, welcome to the Best of Investing.
Thanks for having me, Edward. It's a pleasure to be here.
All right. So, we're talking about single-family rentals. So why have you specialized with that?
Single families are what we feel is like the, plain vanilla entry point. There is multifamily, but, with multifamily comes typically a higher price point which means, longer lead times to raise capital, JV, special structures, where sometimes people just want to get into real estate. They have the capital for the down payment. They just need to know how to deploy it. And the U.S. single family rental market is one of the most resilient asset classes.
What I've been saying for the last, few years here is I also agree with that, mostly because everybody needs a place to live. And no matter how bad things get in the economy, my wife will not let us live in a tent. We may have to downsize, but we still have to live somewhere. And I always say, without getting political, no matter what side of the aisle you're on, the fact of 10, 15, 20 million new people coming into the United States, whether it's legal or illegal, they're not all going to live at the Roosevelt Hotel in New York. That's going to get spread out. So now the interesting thing is, like, where are you located?
I'm actually in Toronto, Canada. I'm a Canadian. Okay. Spent a good amount of time living out in California, and then was introduced to the U.S. residential market, servicing the American market from Canada.
Okay, so I don't know how the Toronto market is, but in California, especially in the in the more expensive areas, I don't know how it makes sense to buy a property and rent it out. Are you finding it is now what in Toronto, is it different?
No, it's I would say it follows suit of your San Francisco, LA, New York, Seattle. It's up there. The average single detached home is almost $1 million plus.
Okay, and how much I'm not sure what you can get for a rental on a $1 million house.
It's a big gap. It's high, but not high enough. Like you're not capable of cash flowing with like a 20% down payment unless you're self-managing.
Yeah.
And even that's kind of razor thin. And then the landlord rules are really kind of against landlords in
Toronto, just like that. Yeah. Toronto's a little bit liberal city, isn't it?
Yes, very. Yeah.
Yeah. So are you're gonna guess you're buying outside of Toronto?
We're only buying in the U.S. Across the Sunbelt states in the Midwest.
Yeah. Because at that point, it seems like you can buy a house for $100,000 and rent it out for like $1,200 a month or something.
Exactly.
We'll get into this when we get back from the break, but because the thing I find is interesting is certain costs are going to be about the same, like carpet, hammers and nails and stuff like that. And so at some point, if you get too cheap a house, it might not be as good when you have to manage. But we'll get into that in a minute. We're going to cut to our first commercial break here. All right. Let's see. We're talking miscellaneous movie trivia. And as a reminder, Andrew, if you know the answer, don't say anything quite yet. In the 1953 biopic film about the famous Houdini, who played the starring role? So basically, the film is from 1953, and who played Houdini in that film in 1953? Call 888-912-1190. First caller with the correct answer wins that tanning certificate. Do want to make a mention here for Dr. Wilkinson's Backyard Resort and Mineral Springs, voted best natural hot springs in Calistoga by Travel and Leisure magazine. Check them out at drwilkinson.com. Again, we're going to ask the trivia question here. In the 1953 film about Houdini, who played the starring role? All right, stay with us. You're listening to The Best of Investing. Don't touch that dial. We are going to be right back. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with my special guest, Andrew Kim. First trivia question. In 1953 film about Houdini, who played the starring role? Any idea?
I don't have a name. I know the face. And I think it's the same lead actor that was in Casablanca. I'm not sure if that's the same actor.
No. I think that was Humphrey Bogart. This was Tony Curtis.
Oh, okay.
And interesting, as a side note, my mom told me that she went on a blind date with him one time.
Really?
Yeah, just somehow
Wow.
they got hooked up. That could have been my dad. Can you believe it? That would have been Jamie Lee Curtis's brother. All right.
Oh.
But okay, so we have a special guest, Andrew Kim. Now, from Share, SHARE. What does that stand for?
Share, our backgrounds, tech as a retail investor, and then my co-founder coming from the large institutional multi-single family world. We feel our mission is financial freedom through real estate. We wanted to kind of share our learnings along the way and help others achieve that same thing. So that's kind of where the name came from.
All right, fair enough. I know. So I wanted to ask you, when you're buying the single family rentals, what price ranges are you looking at?
So we have like three categories, kind of classify them A, B, and C. I would say it ranges from 150,000 to 350,000.
Okay, and what are the rental incomes that you expect from those places?
We're looking for that gross 1% yield from price to gross rental income on an annual basis.
Okay. So on $150,000 house, you're talking about
over $1,000 a month.
Over $1,000 a month grow. Yeah. Okay, that's 1% per month. And then your expenses are going to be, real estate taxes, insurance. Are
you familiar with cap rates? We typically use cap rates, so anywhere between 4 to 7% cap rates. So
are you buying all cash, or are you borrowing from the bank?
So we actually match. So we work with every retail investors, and based on their financing strategy and sort of buy box, we will go and find for them. So it could be a mix of cash, DSCR loan, private money. It's a slew. But we basically try to pair each of our buyers up with all of the necessary lenders and resources they need to actually get the purchase done.
And are you doing JVs, syndications, partnerships?
We don't do syndications. We will facilitate a JV if we have a group of individuals that come and say, hey, we want to collectively purchase, then we'll kind of do all the paperwork and set up all the entities accordingly.
And then how do you get paid?
Yeah, we take, there's two parts. So basically we source the deal and then we take a long-term management role. So there's an acquisition fee of 3% of the purchase price. And then an asset management fee, which is anywhere from 25 basis points to 100 basis points a year of from the original purchase value.
Okay, so just trying to do the math here. So you buy a property for 150,000, and you're going to collect, let's say, $1,500 a year in rent. Management, right?
So management, so $150,000 house will put you in the 0.5% range. So the annual fees will be around $7,500 or $750
per year.
Per year.
per year. Okay. That's actually very reasonable. It works out to be about 5% of the gross sale or gross rent.
Yes.
That's a very reasonable price for
Yeah.
that. Okay.
I mean, there's
And
still
then are you,
PM costs there. There's still PM costs, but together, like it works out to be about like 9 to 10%.
gotcha.
But we are like doing like master contracts with large institutional property management companies. So it's not a boutique mom and pop shop. It's a big outfit. And then we bring in all the necessary players to get all the discounts along the way. Our landlord insurance is typically 20 to 50% cheaper. Our entity formation costs are probably rock bottom. And same with our sort of annual tax bookkeeping and accounting practices.
So it's not just your company, but you're facilitating with larger companies.
Yes,
Very
exactly. Yeah.
You're
So
sort of like the manager of a manager in a way.
exactly. Yeah. So like in the sort of the technology world, there's all these big tech companies, and I know you're in the Bay Area, so you must be exposed to this all the time. There's a lot of these
Sure.
real estate tech companies that just service, the Blackstones and the Invitation Homes of the world.
Yeah.
They will never touch the retail client, and lo and behold, there's a lot of value that should be passed through. So that's what we're doing. We, as an institution, air quotes, are plugging into them and then passing that quality and cost down to our clients.
How many, or how much is your AUM?
Right now, we're just north of 6 million. Been in operations for about 2 years.
How many properties is
Just
that?
over 65.
Okay. Yeah, because like you said, the average is about
Yeah.
100,000 a house. So what I've always found, we're going to get, I was going to get into this now, but it looks like we're going to run into another break here pretty soon. But I wanted to see how do you deal with the fact that, if you have to put carpet in, carpet's going to be, excuse me, almost across the board, no matter where you live. If you go to Home Depot, it's going to cost the same. So how do you kind of balance that out with the more expensive houses? Kind of curious as to how you do that. Let's go to our next commercial break. We're talking movies here. Which actor won Oscars for his performances in Kramer versus Kramer and Rain Man? Right? Call 888-912-1190. First caller with correct answer wins that tanning certificate, which, by the way, is worth over $100. And we have a new sponsor, the Lum Hotel, just minutes from LAX. The Lum Hotel offers travelers a comfortable and convenient stay in an exciting neighborhood. Its prime location provides easy access to major attractions such as SoFi Stadium, Hollywood Park, and the new home of the Clippers. Check them out at lumhotel.com. Stay with us. You're listening to The Best of Investing. Don't touch that dial. We're going to be right back. Welcome back to The Best of Investing one more time. I'm Edward Brown, your host, along with my special guest, Andrew Kim of Share. Trivia question number 2. Which actor won Oscars for his performances in Kramer versus Kramer and Rain Man? Andrew, what's the answer?
Dustin Hoffman.
Dustin Hoffman, very good. All right, you're batting 500 so far. So before we went to break, I was asking a question about the fact that, if you're looking at deferred maintenance, sometimes the costs, like maybe a plumber might be a little bit cheaper in Wichita, Kansas than he would be in San Francisco, but, new carpet or certain, like plumbing fixtures are going to be about the same. How do you manage all that?
So before we acquire a property, we do all that diligence. We actually give you kind of a 10-year pro forma, and before you acquire it, we go through, do the full run through inspection and price out everything from a local contractor or local renovation team from our PM partners. And, we've got it formulaic. We would probably never go carpet, more like vinyl planking floor. But we price that all out. And I think the beauty of us working with institutions is we get a lot of wholesale costs as well. So we pass that again. We don't mark that up. But yeah, pretty formulaic. Based on sort of A, B, C neighborhoods, we'll say, okay, this is going to be LVP versus, what's the other planking wood, or the countertop should be laminate versus quartz. So we've kind of got the formulaic pattern algorithm down.
How big is your staff?
We're 7 full-time, and then we work again nationally with some large property management partners that have like several thousand doors. I would say our smallest partner has like 3,000 doors in a specific metro.
Gotcha. Yeah, because I was gonna say that you can't have one management company handling all the because if you're in the Sun Belt
Yeah.
area, you're talking 10 different
Yeah.
states, and you have to have hands-on in each
Yeah.
one. So these managers have hands-on. That's a really good, very interesting. And so like you're on this show, people would want to get a hold of you how?
Yeah, go ahead and create a free account on our website, share SFRs in singlefamilyrental.com. You can see all of our past
Okay.
deals, speak with our investment team, get an investment plan built together for you, so you can understand everything from end to end on what it takes to get into the real estate market to buy your first, then your 10th home.
Okay. So the typical investor, do you have to be accredited
No,
investor for
no,
this? No. Okay. Yeah, because you're not doing a
no.
syndication. If I came to you, I would buy one specific house,
Yes.
basically. Okay. And let's say, just to make the number simple, it's $100,000 house. My fee would be $3,000. So I'd basically be paying $103,000 for the house. And let's say I guess to make it simple, I pay cash for it because you never know what
Yep.
interest rates, how much down payment and all that. If I pay cash for it, what's my anticipated cash on cash return?
On 100% cash, you're probably
Yeah.
gonna be looking at 7% returns roughly.
Okay.
But we don't like.
Well, that's not so bad. That's
Yeah.
not bad. I mean, especially for 100%, and then you get some depreciation to
Yes.
offset that.
Yes.
And then in theory, the property goes up in value, et cetera. And if there's a vacancy, again, you're managing the managers who
Exactly. Yeah.
who do that. But though, for a 10% fee, if that's all inclusive of you and those other managers, that's still pretty reasonably
Yes.
priced.
And we're also, again, we pass through a lot of discounts, and we're not just like property managers, so we know what your sort of financing stack looks like and your capital stack, and we're going to be the ones that are actively saying, okay, let's go refinance. Here's a lender. We should pull that equity in, or 1031 it. Your IRA will help you do that, facilitate all that for you.
Yeah. Yeah, because this is allowed for our IRAs. So what's the difference between property management and asset management?
Yeah, I love property management companies, but when they're working, their job, the best situation for them is to do nothing and collect their fees, right? So, they're reactive maintenance, and when you're a busy individual and you're looking at real estate as a passive way to kind of pad your income or a faster retirement plan, you need somebody to actually want to grow your portfolio, and a property management can't do that. And I think everyone's just so accustomed to saying, I'm going to buy a property, work with a property management company, but then life gets in the way and your portfolio stagnates and doesn't grow. So yeah, as asset managers, we're actively looking at your performance and your returns to make sure that we can continuously grow your portfolio.
Okay. When we come back, I do want to ask you the question about who needs an asset manager, right? I mean, hey, you could just do this yourself, right? From 2,000 miles away. Yeah, good luck on that one. Okay, here's our third trivia question. In which television series did Roger Moore star from 1962 to 1970? If you remember, later on, he played James Bond, but before 1962 to 1970, what television series did he star? Stay with it. 888-912-1190. First caller with correct answer wins that tanning certificate. Stay with us. Welcome back to the Best of Investing. I'm Edward Brown, along with my special guest, Andrew Kim. Third trivia question, which, by the way, off the air, both Andrew and I agree that Roger Moore was the best James Bond, which, by the way, it's funny. Last Saturday, I saw for the first time on Her Majesty's Secret Service, which was the only one where George Lazenby was in, the only one who gets married, and it led a lot to be desired. Okay, 1969. Okay, in which TV series did Roger Moore star from 1962 to 1970? So this is pre-James Bond.
I feel like I know this, and I'm going to be very upset when you tell me, because I should know this.
Exactly.
Yeah.
Ready? The Saint. Insane.
Yes,
Remember, he had a little
yeah,
stick figure with
that's right. Oh,
that was a good show. All right. So getting back to what you do for a living with these single family residences, who needs an asset manager? Well, why can't the average person just say, hey, I'm going to save all this money and do it myself and pull my hair out and have lots of gray
yeah,
hair?
no, I think like it's the busy individual. Our clients are typically senior to, upper management, work executive jobs, super busy, or, you know, pretty successful entrepreneurs that really cannot shave off their time, but understand the value of direct
Yeah.
ownership. So dedicating 6 to 9 months of time to do research and stabilize and be on call to the property management company isn't very appealing to them.
No, that's true. I mean, and for anyone who's ever had to deal with problem tenants, hello, me. I can tell you that's for sure. Let's see here, and what else we got here? Now, how does Share de-risk SFRs?
Yeah, so our process and our formula is pretty much very transparent. So we use a lot of data to hone in on the metro, making sure that the local economic fundamentals are in place, the rent, versus ownership, population growth, economic growth, and then we really zoom in on the zip code. So even though we're a technology company, we will never dismiss local subject matter expertise, and that's what we've got a large network of, some of the largest networks in the market. So understanding what the rent rate might be in that market probably comes from some of the largest property management companies that have private data. So not only do we use data to say where are we going to look, but then when we have the actual house, we work with the property management company to actually give us some insights, and then work with a lot of different contractors and inspection companies to really hone in on what kind of repairs and maintenance might be required. On top of that, our head of investments is done over $7 billion worth of multi and single family across the Sun Belt and Midwest. So comes with a lot of institutional pedigree.
Gotcha. And what offers more diversification, SFRs or manufactured multifamily?
Yeah, everyone's always like multifamily, and I can't disagree, having multiple doors, but I do think there is this weird, like this fine line between single family and multifamily, depending on size of multifamily. So, if you're coming in as an initial investor, you've got enough to get into one building, and it's not, I would say, like an A or B product. You're putting a lot of risk in that building. What if you bought during the automotive crisis near the plants? That whole house is in fire, up in flames, right? That whole unit. Whereas now with technology and how we make it simple, we could have you a unit in Dallas, a unit in Atlanta, and now you're diversified to two different markets with two robust job markets. So simplifying that and making it seem like both of these are in your backyard.
And if you have a vacancy, how quickly can you usually
Yeah, so
fill
we
it
have
up?
timelines based again on A, B, C profiles, but we're pretty quick. I would say C's are your longest turnover, where you'd see maybe up to 3 months.
That's not so bad. I can appreciate that. All right, let's see what we got here. What else do you want to share with us?
Sure, no pun intended.
Yeah,
Yeah, what we really want to do is think about the out of state, talk about our client a bit here. A lot of our clients are coming from the major metros of the US. Again, San Francisco, LA, New York, where local investments do not make sense. The economics don't make sense. The legislation don't make sense. We help you source out of state, help you do everything along the way, your entity, your banking, all of your lending, everything from the soup to nuts. So if you're looking to actually hyperscale your portfolio without being involved, that's kind of where we sit.
and you've been doing this for 2 years?
Yeah,
For 2 years? Okay, so it's interesting because you started like right when COVID was still
yeah,
kind of
sticky situation.
happening. That was yeah, you kind of went through trial by fire for a
Yeah,
while there. Uh, Yeah. I do want to let me just shift for a little bit, just to let everyone know what's going on with Pacific Private Money because they're one of the sponsors of the show. So they have a few different funds. One of them I'm a manager of, the Pacific Southwest Note Fund. We just pay a flat 8.5%, and we're buying discounted notes in there, and it's a fairly conservative fund. Those are buying existing notes. The one of the other funds is called the Freedom Fund, and depending upon how much money you put in there, they'll pay anywhere from 8% up to as high as 11%. And they don't fix that rate for years and years though, because interest rates do change. But there's no lockup. So they're asking people to give them anywhere from 3 to 6 months of lead time because of having to balance cash flow out and all that. So I always like to kind of give people that information. Check them out at pacificprivatemoney.com. That's pacificprivatemoney.com. You can check out all the various funds that they have. And let's see here, our last trivia question. You know what's funny? I did ask that question. It's so funny. I was thinking, wait a minute. I usually the last segment I've already asked the trivia question, and I did. Well, you were 1 for 3, so that's still, like I say to people, that still gets you into the Hall of Fame in baseball, right? Well, Ted Williams said the hardest thing to do is to hit a round object with a round, hit a round ball with a round object. Pretty tough. All right, let's see here. What do you, just really quickly before we get to the break, how do you foresee the future looking?
Yeah, so
for just
so in terms of like the market itself, the single family rental market is pretty resilient. Typically, when rates are good, the buying is aggressive. Blackstone's already ramped up. They just bought one of the biggest SFR competitors. We see that buying has kind of ticked up and demand is ticking up. And now with the Fed signaling that they're going to be rate cuts, we do anticipate it start to tick up. So started in the pandemic world shitstorm, sorry, a whirlwind, but making it through the storm and seeing the light.
Yep. All right. Okay. Stay with us. You're listening to The Best of Investing. Don't touch that dial. We're Welcome back to The Best of Investing. Last time for today, I'm Edward Brown, your host, along with my special guest, Andrew Kim of Share SFR. So we don't have a trivia question now, but I do want to ask you, aren't there some laws coming out where they don't want companies like Blackstone, BlackRock, et cetera, to buy single-family residences for this reason, taking them off you're turning everybody into a renter?
Yeah,
so to speak?
there's been a lot of bills trying to attempts being passed for the last 2 years. We don't play in that realm. So even though we're sort of utilizing the institutional world, we actually are trying to get the money back into the hands of the people, right? The retail investor. So our clients won't be affected, but maybe some of our service providers will be. So for the
Gotcha. Do you ever do lease? Do you ever offer lease to own to the tenants?
We don't. We know we want to. There is a program we could plug and play, but I think for now it's just building up initial traction and then kind of rolling in these new options for our clients.
I mean, I remember right after the 2008 crisis, I think it was Warren Buffett who said, if I could figure out a way to buy a whole bunch of single family residences and manage them,
That's like our marketing material.
Do you use that?
All the time.
I mean, that's the bingo. It's and I think mostly it's just there's so much regulation, like where I live, that it just doesn't make sense to build houses. And especially, you get too many, as they call them, NIMBYs out here where, we love everybody. Oh, just don't build in my backyard, Yeah. It's so funny. I saw this video, YouTube, where they were asking this guy, they're just asking people on the street. So what do you think about, allowing illegal aliens in the country? Because I think it's just great. They help society, blah, 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 right? And so the guy he has this plant, basically, this guy who is, from, Honduras or something, right? And he speaks English. And they go, well, look here, we got a guy right here who's looking for a place to live. He can live with you, right? Oh, thank you, senor. We'd love to do. No, wait a minute. I don't want that. It's like the rest of the country.
That's great.
In fact, was it Massachusetts where they were trying to get the average citizen to open up their home?
Was it? Oh, yeah.
Did you hear about that?
I hear conversations about that. Did that actually happen?
Yeah. They asked for people to do it, but
Oh
I
my
don't think
gosh.
they forced it. And I think there was pushback. I think there was like one lady on TV who said, "Oh yeah, open up my house to this person," and she ends up cooking and cleaning. So it's sort of like having your
Oh
own
gosh.
maid. I don't think that's the message you wanted
Yeah.
to send, but listen,
Valiant
hey,
effort.
everybody's got when the kids come home from college, they got to cook
Yeah.
and clean too, right? Nobody gets free
Oh,
ride, so but the optics of it
yeah.
looked a little bit funky. So Andrew, share your information one more time if the audience out there wants to
Yeah,
get a
so
hold of you.
share sfr.com. Create a free account, book a call with our team. You want to email me directly, andrew@sharesfr.com.
And you're kind of the one-stop shop because you said you'll help people set up their
Yep.
LLCs to buy these. It's interesting because people set up LLCs for protection, but in theory, that's also why you get the insurance.
Yeah.
That's supposed to protect you too, but maybe it doesn't protect
Yeah.
you
And the
for everything,
lenders often
right?
require the DSCR lenders. Yeah.
Gotcha. Yeah, that's true. All right, you ready for our thoughts for the day? Here we go. So Groucho Marx said, when you're in jail, a good friend will be trying to bail you out. A best friend will be in the cell next to you saying, dang, that was fun. And love is blind, but marriage is a real eye opener. And from those of us who have been married longer than we can remember, I don't know if I was born first or married first, I could say that is true. No, they're actually going on
Oh,
35 years here.
congratulations.
All right. No, love my wife. All right, thanks. All right, audience, tune in next week to The Best of Investing. We're going to be giving away more free prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm your host, Edward Brown. We'll see you next week. So long.